talking about mindset, both quadrants, and tax strategies. The concept of cash flow quadrants come from Robert Kiyosaki, which is the author of Rich Dad Poor Dad. And basically, he divides cash flow quadrants or tax quadrants into four main categories that can be abbreviated by ESBI, from highest to lowest taxes. So, starting off with the highest is employees who are individuals working under an employer. They earn gross wages, but those gross wages are like taxed and they get a net pay. Those taxes usually average around like 30 to 40%, which is pretty high. And then next is S, self-employed individuals. They work for themselves rather than like a system under the employer. And their income is tightly tied with the product or the service they are able to provide. And they do pay a less percentage of income tax, but they do have to pay self-employment taxes. The third is business owners, which is lower. They're the owner of a system and they're the employers that hire the employees. They are able to use the business to reduce taxable income legally with deductions, depreciation, and business expenses, which are tax deferred or tax free in comparison to personal expenses. And I think Cassie mentioned it, how billionaires are able to pay less taxes. Another method used by Elon Musk is that he would, instead of a salary as CEO, he would take the stocks of Tesla and then go to a bank using those high credibility, high potential stocks, and he gets a loan out, and then he spends that loan because a loan is a debt, so you don't get taxed for a debt, and that's how he's able to live tax free if he's like, or like pay less taxes if he's paying any. And then the which is tax lowest in tax, which is the investors, they earn passive income through investments with like dividends, capital gains, and investment incomes instead of active. And to differentiate these taxes, we have another slide here. So ES is like the higher tax rates, and that is because they earn active income, like the tax dependent hourly wages. And those are like those require like high taxes, and then for the self-employed individuals they also have to pay another self-employment tax. And then for B and I, which is business owners and investors, they are able to require like less effective taxes because they mostly earn income through passive or leverage income, which comes from like rental properties or partnerships. And using their businesses, they're also able to use tax benefits from business deductions, depreciation of assets, capital gains, which is a lot less than income tax, and deferrals and shelters, which is reinvestment into their own company. So shifting from high to lower quadrants, there are many methods to start doing this. First of all, financial education, knowing your tax terms, your basis, your job status, etc. It really helps. And then the next one is mostly for self-employed individuals to move into lower the lower quadrant, which is business owners. They can create like more scalable systems, which allows the transition. And then next, investing profits back into the company. And lastly, using legal tax strategies to lessen tax burdens. And this includes incorporating, reinvesting, and use of tax advantage accounts in order to like minimize taxes as much as possible. The main takeaway of this book from Robert Kiyosaki is the poor and the middle class have work work for money, while the rich people, they make the money work for them, meaning that they're able to like manipulate the money and then use money to like grow money and reduce the amount of expenses. The second topic is entrepreneurship, specifically for students. So the benefits of starting entrepreneurship at a young age is, first of all, the quadrant shifts. It allows the students to go from a higher quadrant to a lower quadrant at like a young age and have that experience, developing soft and hard skills like designing, marketing, finance, communication, management, which is essential in life later on as well. And then also personal growth, because while you develop a business, it directly teaches you about management and then a lot of financial literacy and independence throughout the process of owning and managing the business. Here are the different types of startups. So starting off with the two most common ones, they are the sole proprietorship and the LLC, which is the limited liabilities corporation. So the first one, it is the easiest form. There is no separation between the business and the owner in terms of liability accounts, meaning there is no liability protection. And you do have to pay self-employment taxes for this type of business. The next is LLC. This is the most common and most convenient and less risky method and type of startup. So the business and the owner, they have like separate liabilities, which provides liability protection, and it's has like a flexible taxation. Um, could be for a partnership or a sole business. And then next off is S corp. It is more complex, and it is more for like smaller businesses. Salary, you can pay a salary to yourself, and the extra profits can be used as dividends to give it to yourself, and dividends are also taxed less. It does require more paperwork and have more IRS rules in the process, however, and it avoids double taxation, which is good for potential payroll tax and helps you save money. And then C Corp. C Corp is basically what you see for stocks, and it allows raise for investment and issuing of shares. It is more complex than the other three, and it does it is able to separate legal entity as well, like an LLC. The business and owner have like separate liabilities, and it doesn't avoid double tax rate like S corp, and it also require requires like around a 21% cor- federal corporate tax rate. Unlike the S corp, it's usually like the larger companies. So reducing tax. First of all, I can track all business expenses because business expenses are usually tax-free or tax-deferred in comparison to normal personal expenses. And then also forming an LLC or S corp. These structures kind of allow you to kind of pay yourself a reasonable salary, and there are additional like profits that you can take as distributions, and like they are taxed a lot less in comparison to salaries. And investing back into the business, again, reinvesting into your own business, into equipment, marketing, etc. It's a way to like kind of avoid income taxes. And then the use depreciation. So depreciation is a part of expenses, and then assets minus the liabilities is what you get for your income, and it decreases the income as an expense. And so leverage tax credits, there are a lot of organizations and credits out there that students can use to like support like student entrepreneurs on like taxes and helping them like start a startup. An example being the American Opportunity or Lifetime Learning Credit. And it helps business deduction simultaneously. Planning for the long term. So shifting from earning active income early on into passive income, it really helps like you and your employers because of how the tax differences from active versus passive income. And then lastly, profits. So usually starting off, it's either like a neutral profit or you operate at a net loss. And then this negative income cannot be taxed, like for first year entrepreneurs usually. The third topic with taxes in mind, we have investments. So starting off with types of investments, we have stocks and ETFs. This is shares in the company or index fund, and people profit from the growth of a company, which results in an increase in stock price. There is a capital gains tax on this, however. And the second most common is real estate. So buying property or rental income or appreciation, and retirement accounts, which was mentioned previously. This includes like 401s, IRA and Roth IRA, and these accounts are usually tax deferred or tax-free withdrawals. Dividend stocks, um, and differing from like normal stocks, these are regular income from a company profits directly to a shareholder. And for the taxes, the qualified dividends are taxed at a lower capital gains rate. Tax advantages. So long-term capital gains, for assets held over a year, there are lower tax rates, and these tax rates depend on your income. And tax deferred growth, using accounts like 401s, IRAs, or 529, 529s, it allows investment to growth without like much gain annual taxes on the gains. And then dividends and compounding, it helps delay taxable events and also boosts compounding returns over the years, which increases. So here's a starter roadmap into investment. So first of all, just start investing, even if it's like a small amount per day or per month. It can definitely benefit from compounding as long as you're able to like start earlier. And while you do that, also know the basics of investment and financials. So being able to understand tax terms, capital gains, deductions, deferrals, basis, and everything like of the like is really important as you invest. Three, as you start becoming more experienced and you start to diversifying gradually your investments across like different types of assets like stocks, bonds, real estate. And lastly, think in like decades, not days. So like think long term instead of just what is happening right now because the market is always changing. So always be sure to like have like a steady and calm mood while you're investing because it can like grow one day and then suddenly drop the next day. But that is like very normal. So remember to have like a calm mood while you're investing and then be consistent with it. That is the end of my presentation. Thank you.